Well, traders are buying into safe haven assets this morning amid the ramp up in geopolitical tensions. Gold's rally that resumed, and investors buying into treasuries across the curve. Joining us now for more, we've got Michael O'Rourke, JonesTrading Chief Market Strategist. Michael, thanks so much for taking the time here pre-market. As you're thinking about the geopolitical tensions that are ramping up and ratcheting higher, what does that signal to you in terms of the first trade that you would be making off of reports?
I mean, I like treasuries. I've liked them coming into the election, and I know they were getting sold on President Trump's victory. I think the inflation concerns are a little overblown in the short term, and I think the selling was just overdone there. So then you get an event like this, or the headlines like we've had this morning, and that just reinforces the likelihood that treasuries are going to bounce, pushing yields lower. But at a 4.34% 10-year yield, that's a pretty attractive, safe investment.
Mike, how are you evaluating, or I guess how should investors be evaluating the heightened geopolitical risk?
I mean, I think Rick nailed it here. The investors have been somewhat complacent. As he said, the market's been shaking off, whether it's the events in Ukraine, the war in the Middle East. Investors are just, they're excited about a lot of things. They're excited about the election. Obviously, there's still a lot of work to be done, and a lot of transition has to occur. That just because someone's elected, things don't automatically become policy. So we've seen a lot of euphoria out there that I think it's really going to be hard to sustain once you have to start transforming some of these goals into policy.
What do you think are the top policies that markets are already pricing in, and how is that playing out within your own strategy?
Well, I mean, the main thing is everyone's expecting the government to cut a tremendous amount of spending that's considered waste, and that will help fund the deficit and will help fund tax cuts and also fuel deregulation. So those are all tied together. But in the same respect, it's rarely do we get everything we want, and the devil's in the details. And of course, we really don't have details. But the market is seeing, the glass as more than half full, and that is why there's so much enthusiasm out there. I think going to year end here, investors should be a little more cautious. We've had a tremendous run, tremendous year, and we're pricing in gains that or expectations that really it's going to take time and work to achieve. But on top of that, equities are very expensive here. They're at one of the most expensive points in past 3 decades. So investors, it's a great opportunity for you to be a little more defensive here.
Michael, how does the Fed factor into your expectations here? Not only between now and year end, but looking ahead to 2025 and what you think the pace of this cutting cycle maybe more realistically is going to look like?
Well, that's a great point, because the Fed came out in September, gave this very, very dovish outlook on interest rates, expecting to cut, down to about 3.75% by the end of the next year. And what we've seen is, relatively strong economic data. And of course, we're going to have a different presidential administration that is going to have entirely different policies. So it's almost, you have to take that forecast and just throw it out at this point. I know Chairman Powell said, things aren't going to change in the short term until policy is enacted. But that said, we know the policies in 2025 will be distinctly different than 2024, and investors should be prepared for the Fed to shift strategy here. Right now, the markets have begun pricing that in. The market sees the Fed funds rate, I think, around 3.8% at the end of next year, about 50 basis points above where the Fed forecast was. So I think the markets are adjusting to that, but it's something investors need to keep an eye on.
Do you see policy throwing off what the Fed has really kind of come to expect right now in their policy pathway, especially as we already know, and as you mentioned a moment ago, $2 trillion in cuts, plus if there were mass deportations, you're talking about potential hits to both elements of the dual mandate that the Fed has really been leaning on in order to go forward with their target right now.
I mean, that's it's a great observation. These are seismic shifts you're talking about from a policy perspective, and what the Fed is going to have to do is they're going to have to navigate those shifts. So they're going to have to see which way which way the economy moves with these events. And the question is how much of the events are actually going to be move into policy in 2025, and how much of an effect are they really going to have? So I think what you really have to do is just look at the environment we're in. Thus far, we have a very good economy that's been, relatively strong despite a high interest rate environment. The Fed has significantly eased already, and now they just have to wait and see how the policy takes shape and how the president and the administration executes that policy.
All right, Michael O'Rourke, Chief Market Strategist at JonesTrading. Thanks so much for hopping on with us here this morning.